All right, fellas. Today is well. Let me first ask you guys. Can you guys hear me? Moss, CAC, Ayush.
Yep. That sounds good.
All right,
Yep.
perfect, awesome. Today is Sunday, August 23. The agenda is quite clear. It's going to be current events, the path to profitability. Then we'll end it off with a Q&A. I hope everybody's having a good weekend. We're gonna do our due diligence tonight together, and yeah, so we can attack the week better. Anyways, start off with talking about oil, bonds, and the Fed, because there's three
Hey,
things
yo,
that
before you get into it, bro,
sure.
I just want to say everyone in the room, like, you know the deal. Like, repost. Let's get it out there. Let's get people in here. I see like one repost, bro. Come on. We can do better.
Hell yeah. Come on, people. If you can't click a button, you won't be able to get in the trades that we alert on time. So I appreciate that, EAC. You guys can like, repost. That's the bare minimum. Anyways, now that you guys are aware of doing that, let's dive into today's discussion. First topic, oil, bonds, and the Fed. Now, there's three things that move the markets. That's the interest rates, inflation, and the labor market. We're not going to dive deep into the labor market. It's mainly going to be on inflation and interest rates. So the interest rates relate to bonds, and inflation relates to oil, the price of oil. We'll start off with let's go for bonds, because bonds, what will happen in the bond market is is what caused a repricing of risk in the general markets like stocks and crypto. So just last week, the U.S. Treasury came out and said that they're going to be doubling their repurchases of long-term bonds to 4 billion per month. Um, Now, how bonds work is they're just a form of debt. So what the Treasury is essentially doing is they're using up debt to repay debt. But that's not the goal of this whole intervention. The goal of this intervention is to drive down long term rates. Because what happens in the bond market is the more the bond is being bought, the lower the interest rate or yield slash return is from that bond. So upon the intervention, we saw the 10-year, 30-year bonds both pretty much, I wouldn't call it a crash necessarily, but the yields did come down. So it did initially work to drive down long term rates. But, and okay, yeah, I won't get into the but. Anyways, the intervention worked for a bit. It drove down long term rates. And overnight, we saw the markets price this in. That's what caused crypto to kind of go parabolic. It helped the stocks go up a bit too. Because buying up the bonds kind of showed investors that, well, the government is here to kind of give investors a backbone. It's a form of kind of bailing out the economy without saying that you're bailing people out. So they buy up bonds, the yields go down. That means risk assets get to get to go up. But what happened the same week is that the bond yields went right back to the prices that they were at before the intervention, because the bond market is more for people who are financially savvy. They're not going to get kind of a sense of FOMO, or just start, purchasing even more bonds, or ask for a lower yield just because the treasury's taken certain actions. So the bond market adjusted itself and went up again. That's kind of what slowed down the continued upside, ending off the week. Now the future kind of outlook you got to look out for is, and the risk that you got to keep in mind is that you want to see the continued interventions by the U.S. Treasury actually have real effect, uh, for the long-term rates. If the rates keep staying elevated, that's a higher interest rate you're getting, and risk assets will probably come down if that happens. Intervention doesn't work, risk assets go down, especially headed into the midterms. Because usually what happens during the midterms is the markets generally tend to sell off a bit. Now, the interest rates kind of tie into inflation as well. And the most important factor for inflation in today's day has been oil, because the price of oil is quite elevated. Um, we had some form of a peace deal a few weeks ago that completely fell out, and U.S. and Iran were back to bombing. U.S. was back to bombing Iran. The war keeps going on, and each time there's an escalation with the U.S. and Iran. They fight over the Strait of Hormuz, which controls about a little bit over 25%, I want to say. I might be wrong, just a tad bit off on that percentage. But around that percent is how much of the world's total oil supply passes through the Strait of Hormuz. So if you cut off cargo ships from traveling through there and allowing easy access for other nations to get oil, the price of oil gets elevated. That's directly tied to inflation, because to get any types of goods, they need to be transported, right? It's not just the oil that needs to be transported, but other goods as well. Like, let's say, could be fruits and vegetables, could be clothing. And what companies or businesses tend to do to keep their profit margins, stable, or try to increase them as well, is they'll account for that extra transportation fee that they've got to pay. So you can see the prices of goods going up. Let's say you go to Costco or something and you try to buy beef. Well, I'm not going to say beef. That's a bad example because Trump's working on bringing the price of beef down. But let's say apples. Go to Costco, try to buy apples. The price of apples could be up maybe 5 to 15 cents in a few months. That's if the price of oil stays elevated. Businesses will try to keep their profit margins higher. Now, the whole goal for the U.S. is to try to bring down oil. If they bring down oil, they're able to get a lower inflation reading and make sure that they can actually handle the inflation rate. Iran's goal is to keep oil elevated and keep control over the Strait of Hormuz. That's their economic lifeblood for their nation. So we're kind of stuck in this dilemma as investors where who do we really believe? Do we believe in the US and bringing the price of oil down? Or do we believe in Iran that they'll keep fighting and keep the price of oil elevated? So that's one of the risks that we've got to look out for. The main risk, well, another risk I've already mentioned is the intervention by the US Treasury with the bonds. If the long term rates don't go down, it's no good. I'm sorry, I might have gotten cut off there, but if the long term rates don't go down, that just means higher borrowing costs, takes more money to pay off debt. Um, and that could yield in a sell off across risk assets. Could be stocks, crypto, any risky investment. So tomorrow, Scott Bessent does have a press conference that he's holding um, around, I think it's 2 p.m. Eastern. So that's 2 hours before the market closes. That's something that you could be aware of for tomorrow. Um, but that press conference is probably going to be related to the economic escalation that the U.S. has taken upon Iran. Now, we discussed this last week as well, right? If bombing the country isn't doing what you isn't giving you the results that you tried to achieve, then you can try to weaken the economy and force Iran to kind of try and make a deal. So that's the next step for them. Um, they could do this with higher tariffs. They could block out trade for Iran from other countries like China and Russia. They could add sanctions to countries like China and Russia to prevent them from making trade deals with Iran. So that's probably what tomorrow's press conference from Scott Bessent is going to be consistent of. But as an investor, you want to see oil prices come down, get low inflation, and you want to see long-term rates come down as well, get a lower interest rate. Now, my speculation leads me to believe that if the U.S. Treasury is successful in bringing down the long-term rates and able to fabricate the inflation reports to show that inflation isn't rising as rapidly as it was, then they'll be able to artificially lower the interest rates and keep this kind of AI boom going. Because the whole AI boom, or the whole stock market in general, is completely dependent on debt. It's all leverage that's being taken on by these technology companies. And well, that's what we call the NVIDIA circle jerk. A company's borrowing money, they're using that money to pay off the next company, and that next company, company B, is using that money to invest into the third company, company C. And you see how they're just rolling the money over and just issuing more debt via their bonds and trying to invest in this kind of whole technology race. You need lower rates to make it easier to borrow that money, pay off that debt, and it relieves the pressure off of risk assets. And another reason that the Treasury is ramping up their bond purchases is that the liquidity in the bond market has been thinning. So every month they do an auction for the bonds where investors are able to either purchase the bonds or stay out of the auction. For a while now, we've been seeing through the data that there hasn't been enough bond purchases from investors as there used to be. And in fact, other nations also have been kind of dumping their US bonds. And that's what's caused this thinning of liquidity in the bond market. So that's another goal for the US Treasury, is to make sure that there is enough liquidity to support the bond market so that you don't see kind of an overhead risk from the bond market that could cause a ripple effect into the rest of the economy as well. We need we need to lower long-term yields, make sure there's enough liquidity so that the bond market is healthy enough and doesn't cause issues later on. Now, this is directly tied to the operations of the Fed as well, because the Fed has to look at the bond market as well. It's what the Fed uses to print money in the form of quantitative easing. Now, the Fed has two goals, or what they call their dual mandate, is high, stable prices and low unemployment. And so what they do to make sure that they can achieve stable prices, which is low inflation, is they could adjust their federal funds rate or the interest rate depending on the trend of inflation. So at this moment, inflation is sitting a little bit over 4%. It's higher than their goal of 2%. And this is a direct risk that the markets have to account for. Because remember, what I mentioned before we dove into the first two topics of oil and bonds was that there are three things that drive the markets: inflation, interest rates, and the labor market. We're specifically talking about interest rates now for the Fed. Inflation has been elevated. Their goal is 2%. They're not anywhere close to 2% at this moment. We've got the next Fed meeting in September. I think last time we discussed it might have been like the second week of September, if not mistaken. And not only do we have that Fed meeting in September, we've also got Kevin Warsh speaking at Jackson Hole this Friday. So he's going to have a press conference at Jackson Hole, and usually this press conference tends to be a negative catalyst when the Fed speakers are speaking, or the Fed chairman is speaking, because he gets to lay out the risks and answer questions on how Fed policy might be shaping up. I do expect that since inflation is high, he'll be a bit hawkish. Can't be too dovish because you can't hide the fact that inflation is high. And that could lead to some downside in the markets in the coming weeks. Best way to fight inflation the best tool that they've got to fight inflation is just increase the rates. You increase the rates, you're able to slow down consumer spending. Consumer spending slows down. Businesses will have to adjust their prices of goods. And there you go. You've pretty much lowered inflation. It's not the easiest thing to understand. So just a tiny bit complex, but I'll get you guys visuals for this to to understand it a lot better. So we've kind of laid out the risks. Watch what's going to happen with the oil prices. Watch to see if the U.S. Treasury intervention has any real effect in keeping long-term rates down. And watch out for Kevin Warsh's press conference that's coming up this week. Those are the three risks that you have to be aware of. That's going to be part of your due diligence that you should be doing pretty much every day. Like if and we've been kind of highlighting the importance of doing your due diligence. If you're not aware of what's going on, you're not going to be able to make an educated prediction of where prices of assets could go towards. If you're trading purely on price action, you might get lucky a few times, but you're not going to be successful over a longer period of time. You want to make sure that you keep your winning consistent and your losses you want to try to minimize. So do your due diligence, be aware of exactly what's going on. Now, for the point of inflation as well, we've actually got an inflation report this week. So I'm going to type in news latest just so I could get, or not news latest, my bad, / economic calendar, just so we could get the exact date of the upcoming inflation reports. We've got it here. We're getting the PCE reports on Wednesday, 1 hour before the market opens. Again, three things drive the markets: inflation, interest rates, and the labor market. One of those key things is coming up for you guys this week on Wednesday, the inflation report. Got to look out for the PCE report on Wednesday morning. And then the following day, you've got the second point that drives markets is the labor market. You get your weekly jobless claims. It's a report that comes out every week. Usually there shouldn't be too much of a shift in the numbers for the weekly jobless claims. Sometimes there could be if it's, let's say, a quarter where companies are laying off a bunch of employees. So we've got two reports on that day. Tomorrow we've got Scott Bessent hosting a press conference at 2 p.m. Eastern. And then we've got Kevin Warsh on Friday with a press conference at Jackson Hole. Now, that Jackson Hole press conference is actually, in my opinion, going to have the most weight in kind of the risk adjustment for the markets. It's going to help everybody gauge future Fed policy or potential future Fed policy and give you kind of a deeper dive on the mindset of Kevin Warsh and kind of the rest of the Fed as well. Now, from the previous Fed minutes, we've seen that there were three Fed members who chose to dissent or chose to vote for a hike in interest rates. We may get a little bit more insight, sorry, on if we're really going to get a rate hike or not. Again, you get a rate hike, no good. And this ties back into my speculation that I'll reiterate. I truly believe that the Treasury is trying to lower long-term rates, so borrowing costs decrease, and they'll try to. The government will try to fight inflation. Hopefully, they can get oil prices down. Keep fabricating the inflation reports to show stabilizing or weakening inflation. And at that point, with those two factors, they'd be able to lower the real interest rate. That would be the kind of Goldilocks scenario that I see for the markets. It's not something that has to happen, but I do believe that that is the ultimate goal for America at this point. Um, Another thing that you guys all should be aware of is that Canada and the US, they've been having tariff talks recently. Now, tariffs are directly tied to inflation. It increases the cost for goods and services for businesses, and that cost reflects on consumers as well. So that's directly tied to inflation as well. Um, but from last year, at least what we got from Jerome Powell was that he was highlighting that by the end of this year, or around the second to third quarter of this year, that tariff inflation should be highly priced in, and we wouldn't see any more sudden shocks in the inflation rate. But with these ongoing tariff talks, that risk for those sudden shocks is still remains. So now we're I think 30 minutes into the conversation, and at this point, for the people that have stuck around, what we'll do is we're going to drop that discount code for you guys. And that discount code is going to be for the monthly access to BDT. Mots, do you think we should post it in this space, or do you think it should be in the form of verbal communication? What do you think?
Let's
No
just
answer.
give it verbally
Okay,
in here.
verbal. Yeah, that's what I was
Yeah, I
thinking.
agree.
Yeah, honestly, that way it kind of incentivizes people to be showing up and, you know, put in an effort. That's her goal, man. That's what we want to see. So I'll do regular price is $45. I'm gonna lower it down to $25. All right. That's being more than fucking generous. So fixed amount, 20, duration once. Cool. For the month. Oh, okay. 1 second. The monthly. Cool. The discount code is, let's do J Hole for Jackson Hole. Cool. There you go. It's active. Discount code that we've been dropping every week pretty much. We've dropped a 99% off code for the weekly. We've dropped a 50 to 66% off for the weekly, and we've even dropped a 33.3% off code for the weekly. And now I've dropped a fixed dollar amount code of $20 for the monthly. So instead of paying $45 for the monthly, you get to pay $25 using code JHOLE, all capital letters, JHOLE. So make use of that if you want to. I mean, if you want to stick around, if you feel like you're getting value, make use of these discount codes, because our goal isn't to fucking hurt people's pockets, it's to give you guys as much value that we could give. And that's all we want is whoever's showing up, put in an effort, you get to you get incentivized with time. But okay, so we got to continue our conversation. We kind of briefly went over oil, bonds, and Fed. I think that conversation should continue in the Q&A part of this space, just so we could get more kind of ideas that other people have for it. So I'm gonna begin our second topic for today's discussion, which I think everybody here is gonna find quite interesting, and that is the path to profitability. What does it truly take to make money out of the markets, and not only make money, but keep that money and withdraw that money to your bank accounts? Because it's easy to win on a few trades, but after those few trades, are you able to pay yourself, keep that money, pay off the taxes, and keep your profit, use your profit to for whatever, pay your monthly bills, go on vacation, and whatnot. Now, the thing I struggled with most when I first started was I had no clue why prices of stocks would go a certain way. Because I was a complete newbie. I used to think that, well, if I just look at price, just these green and red candlesticks, that I'd be able to make some money. But that's essentially gambling. If there's no underlying strategy to your trades, you're bound to lose. At that point, go ahead and bet on sports. If you're trading, this is not gambling at all. It's a skill that you're trying to build. So I struggle with kind of realizing what moves these prices. So what I went on to do was I went on to kind of dive deeper into economics and human nature. Human nature, like fear and greed, are essentially the two main emotions that drive markets. And that's why we kind of see crazy parabolic moves that get sold off, or discounts on certain stocks that get bought up. It's just fear and greed that drives these markets. Well, in terms of human nature. Then the economics part, that's kind of what we went over today. What truly moves these asset prices? Inflation, interest rates, and the labor market. It's important to read the data. If you're not reading data and and don't have the ability to kind of price in that data, then you're way behind how these big institutions like hedge funds, banks, and any other money managers truly make their trades. Even the algorithms, if they see a piece of data that lines up a certain way, the trades will be executed at light speed pretty much, and they'll make their money while you're sitting there looking at the charts trying to take a guess that, oh shit, price is going this way, it looks like this to me, and I'm just going to push in that trade. Well, why the fuck are you pushing in that trade? You have no clue what forced the price to go that way. Look out for economic data. Be aware of human nature. What's driving kind of, or what could affect the price further, and just be aware of all the data that you can lay your hands on. Like, we have certain strategies that we use, but those strategies aren't all set in stone, because it's not just a set, or just one set of rules and strategies that are gonna help you succeed. It's gonna be many strategies that will help you succeed, and that's because the markets are so dynamic. And that's I say the word dynamic over and over, and it's even part of the Discord's name, benchmark dynamics trading, because the markets are always shifting. They move in cycles. You get to understand these cycles based on the data that comes out, and you'll be able to navigate the markets with a lot more clarity. So benchmark dynamics trading, we've got the word dynamic, I went over it. And we've got the word benchmark in there because the goal here is for everybody to be beating the benchmark return. What, what is the benchmark return? Well, the benchmark in the market is the S&P 500. What's the return that it offers? 15% per year on average. It could be 12, honestly, but whatever. Let's just call it 15%. You want to beat that benchmark return. If you're unable to beat it, don't trade at all. Don't even invest in individual stocks. Invest in the S&P, sit back and relax. But our goal here is to beat that return. We're trying to make over 15% per year. Heck, we could, it's quite achievable with a low amount of money. Well, initially with a low amount of money to even beat 15% per week. And I'm trying to show everybody how achievable it is through the 500 to 10K challenge. Now, with that challenge, the most important thing that we have to practice is risk management. If you have no risk management, you're letting your trades run to pretty much $0 and letting your contracts expire worthless, then you're losing 100% per trade. Next thing you know it, in two to three trades, you've wiped out your entire balance. You've blown your whole portfolio because you have no risk management. You're just gambling. And again, we're not here to gamble at all. So you've got to instill proper risk management. For me personally, depending on the expiration of the contracts that I do buy, I'll adjust my stop loss based on that. So for more short-term trades, since the contracts are a lot more volatile and sometimes price can shift quickly against a trade, I like to cut my losses quick. So I'll keep a -5 to 25% stop loss. And all my stop losses for all of my trades, I'm always going to let you guys know. So that you guys aren't kind of blind to the risk. And Moss lets you guys know as well. Demi lets you guys know. That's because risk management is important. And that means you got to cut your losers quick and hold your winners as long as possible. So we went over how you could cut your losers quick. Just keep a strict stop loss of -5 to 25% based on how the trade is. Well, that's going to be based off your entry points and the downside or upside risk that you have based on the intraday movement. Now you'll get to learn more and more of how to keep your own stop losses individually by kind of just these trade reviews that we do. So stop losses, cut your losers quick. But how can you hold your winners as long as possible? Because what if, well, because of human nature, remember, fear and greed drive markets. Now, because of human nature, we might see our trade go up 50% and you sell out. And then you come back to that trade and you see that it's gone up 200 or 300, maybe 1,000%. And that kind of hurts emotionally. So how could you make sure that you hold on to your winners as long as possible? Well, what I do is I'll have my stop loss at first in the negative. The trade goes up by 15%. I'll move it. I'll move the stop loss to break even. If the trade continues to go in the in favor of the direction of my trade, then I'll keep increasing my stop loss incrementally. If the trade is 30% in the positive, I'll put my stop at 15 to 20%. If I'm sitting at 100% in profit, I'll increase it to 75%. So that way, I'm decreasing the risk, and at the same time, I'm able to keep holding that contract because we're trying to hold these winners as long as possible. It just increases the probability of you being able to catch that max ROI that we're all looking for from all these trades. So risk management, super important. You're not here to gamble. Don't lose your money quickly, because if you blow your port, you may not have the access to funds to keep your trade-in activities going. And I completely understand that. Like, the cost of living is expensive. You got to pay your bills. You might have kids that you got to take care of. So please, you know, give real meaning to these words. Don't just accept it through one ear and let it go out the other. You have to practice these things with your trading as well. We want to ensure long-term success for everybody here. Following our trades is one thing, but our true mission is to empower everybody so that you guys can trade independently, trade with your own confidence, make your own call outs, your own plays. I can only look at a few charts at a time. Moss can only look at a few charts at a time. Same with Demi. But the more people that we can empower, the better our community gets. We'll have more people looking at a broader variety of plays. It opens up the room for everybody to make more money. So do your due diligence, actually put in time to this venture that you're trying to be successful at. Practice risk management. But I'm going to go back to that first point of putting in time to get good at this thing. Because there's honestly, I mean, I always try and push people to, put in time, show up, go over the material that we've been giving you guys through the stocks channel, through the books channel, the dynamic playbook. Because these are all things that are going to help you understand how the markets work and how you can make your own trades. So I try to push everybody, and there are a few people, like everybody here who showed up today. You guys are the few people that are putting in time. But a lot of the people, honestly, they're just there to copy our trades. And I hate that. Because if you're just here to copy, uh, well, my friend Steve kind of laid it out quite clearly to you guys. If you're just copying us, you're still going to be a step behind. You may not sometimes be able to get the ideal entry. If you don't get the ideal entry, then there's a high chance that your stop loss has to be bigger. So you have the chance of losing more money. So I completely dislike anybody that's just here to gamble and just copy our trades. But I admire the people that are here to put in the time to actually get good at this venture in their lives. Because everybody, I'm sure of it, has the goal to kind of make sure that trading works out for them so that they could try and get rich off of it. But you're not going to get rich if you have no clue why you're making trades. So put in the time, put in the effort, and try to actually learn. It took me over 9 years to. Well, yeah, it's I'm inching in on 10 years now, but it took me around 9 to 10 years to even be able to make my own trades confidently. It took me, I want to say, around 4 to 5 years to get truly profitable, see a real return in my trading. But everything that we've learned along the way, even Mats, he's been in the game for quite a while. Demi's been in the game for a while. Same with Brian. But with everything that we've learned, we're not trying to give to people and try to help you guys speed up the process of getting to profitability. So try to put in that time, because you're not only disrespecting us, but you're disrespecting yourselves too by not trying to learn and do your due diligence. It's the most important thing to getting profitable. Know why the markets move, know how they move, and how you can use these certain movements and things that you learn from the dynamic playbook or any other stocks education material that we give you guys to try and make your own trades. Because at that point, you're going to be the person that's going to be like, hey, I see this on the chart. This is what I've seen in the data. Now, here's a trade that I'm going to make that I'm super confident in. That's truly what's going to lead to your success. Not just looking at a screen, a few green red candles, drawing fucking. Well, I'm not taking a jab at anybody who does use certain patterns, because certain patterns do work. But if that's the only thing you're doing, you're gonna lose. And I guarantee you on that, and I will even bet anybody in that fact. So put in the time to learn. Like, I keep having to emphasize it. And again, if you're showing us that you're here to learn and truly get good, we're going to incentivize those people with time. And that time is these, yeah, and that time is these discount codes that we offer. We've even gave people free kind of weeks or a free month to be in the BDT group because they put in effort. So you get incentivized with time being around, great traders, not to be cocky or anything, like myself, Motts, Demi, Brian. Um, and yeah, risk management, doing your due diligence. Um, those two are going to help you to the path to profitability. Um, knowing why you're doing certain things, why you're making trades. Um, these are all things that I struggle with, and I know the kind of pain that some people are going through, right? The people that have been losing, and that honestly, I connect to you guys on a deep level because I know what it feels like to lose your money. When I started, I lost over tens of thousands of dollars, and that's what forced me to kind of put in the time to actually learn and get good at this thing. And I want that for everybody. I want everybody to be good at this thing because I don't want them to experience what I had to go through. So we want to be able to speed up the process for everybody getting good. I'll keep trying my best to motivate people, but motivation is not enough. You need to be consistent, consistently show up, put in the effort. All you need to do is put in 30 minutes a day. It doesn't even have to be every day, it could be every other day. But 30 minutes a day, put in that time to not looking at charts, but understanding the markets and understanding human nature. And then within the matter of a few months, you'll see a shift in the way that you understand the markets and how you understand risk. And at that point, you're going to be off to the races. That's what's going to make you truly profitable from my experience. Mats, do you have something that maybe you could add or touch up on for the path to profitability for people?
Yeah, pretty much just learning what you're buying essentially. Because when we buy options, we're paying for a chance at profit, and you want to really make sure that that chance is in your corner of the field. Like, you want to know pretty much every bull case there is for a call. Do your research on it. before you hit that buy button, actually know what you're getting into. And also, it's good to look at not the bull, the bear case. Look at the bear case as well, because things aren't definite. Things aren't always going to go up. We have bad days sometimes. Sometimes we got red days. You can capitalize on those too. So for me, it's always looking at both sides.
Yeah, I like that you added that point because that's another thing. Never be strict on. So let's say it's a day that you're going to be trading. Never be strict on your bias. You got to be, you got to kind of flow like water. Except that price could go up or down. Don't be strict on your bias that here's a resistance point. Price has to bounce downwards off of it, or here's a support point. Price has to go upwards off of it. Don't be strict on that. Make sure that you have both these scenarios kind of accounted for. Is it going to keep going up, or is it going to keep going down? Because again, the markets are dynamic. It's not an entity that follows specific movements each and every single day. It's always shifting, minute by minute, hour by hour. So you got to take that into account and make sure that you're using that for your bias as well, for your own trades, or even the trades that we can alert as well. Maybe we could alert a call and you see something, you're like, you know what? I don't agree with it. You get to type that into the chat. We go through it together, share our thoughts and opinions, and we get to come to a conclusion that, okay, you know what? Maybe you're right. Or you know what, maybe you're wrong. You got to use this community to get better, speed up the process of getting to true profitability. And I mean, you guys have access to great study material. You have access to great minds, and you also have access to pretty cool tools as well. Um, well, first of all, the Trader Grader tool makes it a lot easier for us to kind of share our trades and kind of track them for you guys as well. But the Unusual Wills tool that we've recently implemented is a great fucking tool for doing your due diligence. You get to look at net flow. So that helps you with the put to call ratio. What type of contracts are being bought more on the day? Are the puts being bought? Are the calls being bought? You get to use that for your bias. You have the flow command. Which contracts specifically are being bought? You have the highest volume options command. Which contracts are receiving the highest volume on the day? And honestly, I love the highest volume options command because a lot of the times you're gonna notice that certain contracts are being bought more than the other contracts. So on Friday, it was the day that 3 out of the, I think, 10 spots on that list of highest volume options were taken over by Tesla calls. So if anybody ran that command and used that with their bias of maybe Tesla going up, there you go, man. You've got an easy trade to make. And that trade made over 500% that day for people. I didn't get into that trade. But the point is, you got to be using these tools. They're only going to make you better. It's only going to help you kind of receive more clarity and more confidence. Use the /news latest command to get the most up-to-date news. Use the /economic calendar command, how we did today, to kind of get a grasp of what we may be seeing in the upcoming week. And so we already kind of ran that command together. Wednesday inflation report. Thursday, the weekly jobless claims. Friday, we get Kevin Warsh at Jackson Hole. And then Monday, tomorrow, we get Scott Bessent having a press conference. But we're not gonna dive into the Q&A and expand on those topics yet. We're gonna stick to the path to profitability. Demi, is there something that you could kind of add to maybe it's something that you've experienced that's helped you become profitable or make profit in the markets? I so hope this guy's here.
Oh shit! Did you call me, man?
Yeah, I did. My question to you was
Just to confirm, you'd like to call my mom?
No, I'm sorry, my fault. She was fucking.
No, you're good. You're good. No, I was just saying that. Is there something that you could maybe add from your experience for on the topic of path to profitability?
So just you probably already said just like keeping your winners as long as you can. You're pulling your losers. You know, setting a stop loss, setting all that. You gotta have a stop loss. It doesn't matter like how you feel. If you don't even believe in, I didn't believe in stop losses at first, but I do put a stop loss in now. Like it doesn't matter if I'm fucking up $200-300, I'm putting a stop loss in, like, you know, because the fucking market can do whatever. But yeah, stop losses really save your money. And then doing your due diligence, you know, I'm not saying you have to look at the news at all the time and, you know, keep up with the news and all that, but it definitely helps just looking at the news. I'm just like, I mean, as a trader, if you are going to trade, then that's something that you should look at, you know, the news, and that's something you should keep up with and whatnot. Yeah, and I know Bubbles isn't a patterns trader, but that's kind of how I started trading, is more so patterns. But patterns isn't always going to work out for you. That's a fact, and Bubbles is 100% right about that. You can and you will lose money if you just go straight off of patterns. That's why if you mix all that together to make, you know, whatever you got that you're making, you know, trading is personal. So whatever you can conjure up, then yeah, that's like, but you just don't want just patterns though. But that isn't, you know what I'm saying, like Bubble said, some patterns are very, very helpful. But yeah, that's what I got for real. For profitability wise, path to profitability.
And so you've been keeping up with Bitcoin, and like obviously you've got your levels marked out, which is a great thing to do. But you were able to kind of make that more confident trade on the IBIT uh, stock because you woke up and you saw that. Well, you were you were honestly the first person to even make me aware of it. Uh, you saw that U.S. bond intervention, right?
Yep. The bonds were
And yeah, you said yeah.
Yep, coming down, or yeah, they were coming down. Saw a big drop off. What was it, the 19th? And I'm on a work trip right now, and just by luck, honestly, I was watching Shark. I just seen it. I was searching through the fucking you know, the TV channels, and I just saw Shark Tank. You know, I was like, cool, Shark Tank. But by luck, it was on the CNBC channel, which is the news channel, and all they talk about is stocks. Basically, that's all it talks about is news and stocks, and you know, news about stocks, you know, shit like that. But yeah, so I woke up that morning, saw that bonds were down and everything was going up, and everybody was wondering, people were asking questions in the Discord, why is everything going up? I just sent that, and that was that. That was, yeah, that was that. The rest is history, basically.
The rest is history because you caught a beautiful trade, 9,000%. you continue that streak, you caught over 1,000% the next day. I mean, just insane fucking stuff. Yeah, that's the importance of due diligence. You mix it with your certain strategies, whether that's patterns or data,
Yep. Yep.
and you'll be able to make great trades yourself too. Like, dude, Demi sent that picture, and I was just waking up, and so he sent that picture. I took a look at the bond prices. The long term bonds that day were down sharply. The 10-year and 30-year were both down, I think, over 1%, which is quite a sizable. Well, 1% intraday, not a whole
Yeah.
basis point in the difference, but
Yep. You're correct.
down 1% intraday on bonds, and so I left a text in there. Bond price is down. You should see the price of risk assets reflect by going up. So Bitcoin goes up, Ethereum, Solana, all of crypto, stocks go up, mainly technology, and there you go. You've made a great trade that you were confident on.
Take care.
Being confident in your trades is so important.
Very.
If you're trading with fear, you're gonna get out at the wrong times. You're gonna sell before the move that you're truly anticipating. Um, like, dude, that Coinbase trade that Moss made. At no point did he say he's out of that trade,
Hmm.
or even that Weeble trade that I made. I did not say I'm out, but some people might have gotten out, and that's only because of fear. They had no confidence. You got to be confident in your trades, not delusionally confident, but confident because you did your due diligence. You've taken a look at the data, taken a look at the charts, and you're like, all right, there's a high probability of the trade going in my favor.
Yep. And may I add something real quick?
Of course.
When Mops and I and Bubbles put these trades out, we're doing our due diligence, for the most part, but you can't sometimes, like, I know Mom said this earlier, we're not always there to look at the charts, so y'all have to do y'all's due diligence as well. Trading, you gotta be on point, looking at the news, looking at bonds, looking at everything that correlates to how you want to play that day. Because we're not going to be trading for you. We're not clicking the buttons for you, so you're going to have to um, do that yourself. And I see people in the Discord. I mean, I understand that you do want um, clarity on if people are out of their trades, but if they're not saying they're out, then they're not out.
Exactly. Like, the only way to increase your own confidence is do your due diligence. Um, and this relates to anything in life. You can't build a house without looking at the blueprint. You can't complete tasks at work if you have no clue what your task is supposed to be. So how the hell are you going to make successful trades if you've got no clue what you're looking at? Do your damn due diligence, please. Um, but yeah, due diligence, risk management, uh, and engaging with the community. Those are three great ways that you can speed up your path to profitability. And also try to put in the time and effort. All it takes is 30 minutes a day or 30 minutes every other day to get good at this thing and to be able to independently trade as well. We could care less of, we don't want to hurt your guys' pockets. We want everybody to succeed. Moss, you've got your,
Yeah. Another thing
yeah.
with stop losses and take profit. If say we're in an SPX trade and that shit goes immediately 200, 300%, it's a 10-point candle that happened on the minute chart. It was a fast move. This to me is an impulse move. Sell it right away. Every time for me. That's the number one way to preserve that capital, because most of the time I've watched SPX for years, 9 years. When you get a move that's so sharp, almost, I'd say greater than 50% of the time, it's going to rebound back the other way it came. It creates sort of an imbalance. And the way I've always looked at the market is it wants to be balanced, but it's very hard to do so. So it's going to have all these crazy moves. And yeah, always sell the impulse move, or not your entire position, I would say. But for me, any impulse move I get is a definite sell.
100%, and that's a great point on well, that's a great point that you made on that the markets try to find balance. They always want to be balanced. And mathematically, that's what we call a mean reversion. They always, if the market is way too elevated, well, it's going to have a retracement. If the market is way too oversold, it's going to rebound upwards and find that balance. Yeah, mathematically, it's called a mean reversion. It's what all of these kind of institutions use. Um, so you see that imbalance, take profits off the table, secure your profits, move your stop losses higher to instead of being in the negative or break even, to instead being in the green instead.
Yes,
And if you, yeah, and if you're someone that struggles with knowing how to place, let's say, take profits or stop losses, that's an easy fix. Let's say you use interactive brokers. I'm someone that uses that. I just ask questions. How can I place my stop loss, take profit? If you're somebody that uses Robinhood, you could inquire from Demi and Brian on how to use stop loss, take profit. If you're someone that uses Webull, you could ask Moss on how to do it. So if you're unable to understand how to place your stop losses, that's something you have to lock down on. Just ask for help. It's really easy getting help nowadays. If we're not there to answer, go ahead and ask AI if someone else doesn't end up answering your questions. But yeah, you got to lock that down. Your stop loss, take profit. It's all part of risk management. Um, it's only going to help you guys. If you're somebody that trades without a stop loss and you're telling yourself that, you know what, I'll keep a mental stop loss. More often than not, because of human nature, it'll go to your mental stop loss, but you still won't be out of the trade. Because at that point, you're just hoping. Next thing you know it's, let's say, 2 hours left for the session to close. You're sitting down almost 50 to 80% on your trade. You've lost that trade. Why did you continue to hold it? Right? You keep doing that, you're gonna blow your entire balance quickly. So please lock down on the stop loss, take profits. If you don't know how to use it, you got to ask questions on how you do use it on any platform. You can use interactive brokers, Robinhood, Webull, or any other platform. And we'll be there to help you guys kind of understand the user interface and be able to properly have risk management. At this point, we've kind of gone through the bulk of the first two topics. It's kind of Q&A. I'll kick off the Q&A, but there has been a few people that have been saying that they're unable to use the discount code for some reason. And I got to take a look at that. I mean, you should be able to place that discount code. I'm not sure why it isn't working, but I'll take a look. Cool. Yeah. I mean, it should work, but I understand if it doesn't. And if it still doesn't work, what you could do is you could just shoot me or Moss or Demi a DM, and we'll get that sorted for you guys. But now's the time for Q&A.
If you don't,
If you
yeah.
sorry, go for it.
I was gonna say, if you're not comfortable speaking or can't talk, the chat is open. Just throw it in BDT Elites or public chat if you got a question.
Thank you. I was just gonna say that if you're fine with speaking, you can click request a mic, come up and ask your question. And if you don't want people to, well, if you're uncomfortable speaking, you just type it into the chat in the Discord, and we'll answer any question that you've got. Alternatively, if you're not in the Discord and have questions, you could just leave a comment on this space, and we could answer your questions that way as well. I think somebody did ask a question. It might have been Saturday morning or Saturday night. It was on the NVIDIA news of NVIDIA increasing their prices for their chips, and he was asking, how is this bullish for the markets? Well, it's bullish for some part of the industry. It's 100% bullish for NVIDIA because they get to increase their profit margins, but by how much are they really increasing their profit margins? Because they've got to pay the price for memory, and and memory is expensive. So not all news is bullish for the whole sector, but it's going to be bullish for certain companies. And you got to account for which companies are truly able to increase their profit margins off of any price increase or decrease that they implement with their products. We've got Love You on stage.
Yo, what's the deal, guys? Hey, cheers to you guys, man. Rocking out on the earth, doing your thing, man. Been having having you guys on the radar for a couple weeks, man. Stellarness. With the promo code, say if I want to go in and execute that on Wednesday, would that still be available at that time?
Oh yeah, for sure. So with all of the promo codes, what I've done is I've made it so that you could use it whenever.
Sweet.
There's no expiration on your promo code. So if you want to join next month, next week, the week after, you're still going to be able to use it.
Sweet. Thanks, man. Cheers.
No problem. I appreciate you coming up and asking a great question. Yeah, I'll reiterate what the promo code is. It's JHOLE, and that's for the monthly sub only. So instead of paying $45 for the month, you get to pay $25. It's $20 discount. Promo code is JHOLE, capital JHOLE. Let's see. Let's take a look if there's. Do you have good strategies for trying? Well, let me say, Flory asked this question in the Discord. His question is, do you have good strategies for trying to project what move a stock is going to make? Yes. Now, I've been saying it over and over, guys. We've added that unusual whales bot, so please make use of it. So to kind of project the move that a stock could have is you go to the UW bot chat or channel, and all you've got to do is type /implied. You type in /implied, you choose your ticker, could be SPY, SPX, could be an individual company like Apple, but that's all you got to do. You type in /implied, then your ticker symbol, and then it'll prompt you to choose an expiration date for the specific option that you're looking to get the to figure out what the implied move might be, and it's going to tell you that this week the options market is pricing in a plus minus 5% move in the company Nvidia. There you go. You could expect a plus or minus negative 5% move. I mean, plus or minus 5% move. And that's all you've really got to do. That's the best way to kind of make a judgment on how much a certain stock might move. There you go. A couple of you guys are using it. See, you've typed it in. Now you just choose an expiration date, depending on how long you choose to hold that trade for. If it's something that you're choosing to hold for, let's say, a few days, choose the same week expiration. If it's something that you're choosing to hold for, let's say, over a week, use the next week expiration. I tend to use this a lot if I ever do play earnings. Like I used it for the Webull earnings to try to measure their possible implied move. At that time, it was, I think, plus minus 8.5%. Obviously, the move was much higher, but it still helped me kind of measure the move and what I could kind of expect from the magnitude of the move. So Spitfire has used it for Tesla. Typed it in. Implied volatility is 41%. The implied move is plus minus 3.8%. So you could expect a $14 move for Tesla for, I'm not sure, for 828 for this week. Yeah, so a $14 move is what you could expect for Tesla this week. And that, how easy was that, right? Like all you've done is type in a command and you've got your information. Let's see. Another person also typed it in for Circle, ticker symbol CRCL. Again, so easy. Slash implied ticker symbol. Choose your expiration. They chose the expiration for August 28th. And it tells you the implied move is plus minus 7.6%, which relates to a $6.6 move in the stock. You can use that with your bias, make a more educated trade. So yeah, use these commands, guys. Like, we've gone ahead and paid for the whole year's kind of subscription for this bot. And so, I mean, whether you're in the weekly, monthly, yearly kind of sub for the BDT group, you're still effectively getting a minimum of 25 to 50% added value. But you're only going to secure that value if you're truly using all the tools that we've got. If you're showing up, you're putting in the time to truly learn, and you're engaging with the community. Someone asked, if bonds don't stay low and AI investments can't keep up, does the AI run up start to unwind in 2027? So I would say that that's definitely a possibility, because the whole AI kind of boom is based on debt. If at any point it becomes that there's not enough investors providing the liquidity to these AI companies, so what basically happens is each company's got their own bonds as well. Let's take Oracle for example. Oracle's got their bonds. Now they go to investors. Could be institutions, or could be big individual investors as well. They go to them and they say, we'll give you this bond our bond offers a yield of 7% per year. And you give us your money, we give you this IOU, and we're going to use your money, which is essentially just debt for the company, to invest into whatever technology we're trying to create. So if the cost of the interest rates has risen, it's going to be more expensive for these companies to pay back their investors. Their investors could start pulling out their money, and at that point, there's less being spent on the whole AI boom. The markets will reprice that, and you'll see exactly what you said, and unwind in these AI companies in 2027. Now that's if the rates stay elevated. And we discussed this at the beginning. You want to make sure that the U.S. intervention for the bond market actually works. Because if it doesn't work, and the bond yields don't go down, the rates don't go down, there's no point of buying risk assets. If they stay elevated, you're gonna see stocks, crypto go down. For crypto, I'll say continue to go down, and for stocks, I'll say start to go down, because stocks are, I mean, it's still trading relatively near all-time highs. I just tried and couldn't see how. Yeah, I gotta check that out, man. Because WAP does have issues sometimes, and I know a lot of people had issues with that 99% off discount code that we gave a few or a couple weeks ago. And I did hit up WAP to try to get that whole thing resolved. And dude, I'm not gonna lie, the WAP support team is absolute bogus. They're so bad. They take long to reply. When they do reply, it's not an effective reply. So it took me a while to try to figure out why the 99% off promo code didn't work. But they said it didn't work because that's too big of a discount code. Because you're paying for that sub, but they also take a 15 cent fee when you purchase it. And that fee wasn't, I guess, enough to cover replace the 99% discount. And that's why some people weren't able to use that 99% off code. But I figured it out. There's never going to be 99% discount codes anymore. There probably will be 80% at some point, 75%. But we've done a fixed amount of $20 for the monthly today. I think that's quite decent. That's almost, you're essentially paying the price of 1.5 weeks, but you're getting the value of a whole month. So I think that's decent. And we're going to keep doing these discount codes like every week for the people that show up. If you're putting in effort, we love that. We admire you, and we're going to incentivize you guys. At this point, it's just discount codes, but at some point we do plan on doing giveaways. But I'm not gonna get you guys too excited for that, because that's not a promise yet. Gary asked, Bubbles, what's the discount code? Well, let me ask Gary if he's in the spaces. Cool. Asking that, but yeah, keep shooting questions, guys. Okay, Spitfire. His question is, on TradingView, what are the best settings or indicators to use? I'll kind of let Moss and Demi go over that as well on what indicators they use. But me personally, I only kind of use two indicators, because I like to keep things as simple as possible. Because the way that I feel is, if I make things more complex, it's going to be more things I'm looking at, and there's a higher chance of me being scared to get into a trade. So I like to keep it simple. The only two indicators that I use are the MACD and RSI. That helps with my entries and exits. That's all I use it for. They're not leading indicators. They're not going to be able to help you predict the upcoming move. They're only for entries and exits. But Moss and Demi do use, I think, a variety of indicators. So I'll let them touch up on this question as well.
So I use a couple indicators on for the charts. It'd be a lot easier to get on probably a Discord call if y'all are in our Discord. If y'all are in our Discord, it'll be a lot easier to get like on a video chat or whatever, and I can just share my screen and just run through what which indicator does what and whatnot. But I can give y'all a couple, I guess, just right now. Like I got this pivot indicator on TraderView. It's literally probably, let me see, hold up. It's called Pivots Traditional Auto, that shit. Honestly, B4 Trades, he put me onto that. He's in here. That's he's also a co-leader, but yeah, he put me onto that, and that indicator is god like. It really helps with without even having to put your own lines up there. It helps just gauging where it might go. But yeah, I'll do a rundown. If y'all want to hop in a Discord call, I'll share my screen on all them indicators and whatnot.
For sure. Someday we will do a Discord call in the live trade-in voice chat, share our screens, and go over the charts, our mindset, and our thinking. But yeah, Moss, what indicators do you use? Don't tell me you're taking a shit. I'm just playing.
Moths. I guess he's not here.
Yeah, he might be doing
Oh, there he
something.
is.
Man, I was talking.
There you go. You're good.
Yeah, I didn't know I was muted. Anyways, Bollinger Bands 20 and 2. I use those on Webull. It shows your mid, your upper, and your lower fib. Those are kind of like your MAs, your moving averages. One of the other ones I use on all my charts is BP. This is volume profile, and this just shows where price is grouping up at in the different ranges. You'll see me post a chart and say volume shelf or volume node. That's what VP is. That shows me my nodes where price is, going to get dragged. And VWAP. I've always used VWAP. I think that's the only indicator I've really stuck with forever. Learn how to use VWAP. It's pretty cool tool. It acts as like a magnet for price. If price is above VWAP, you might be looking for a short position back to VWAP, and vice versa. If it's below, you might be looking for it to get back to VWAP for a long position. And then as far as it goes for indicators on the chart, on your bars, I use RSI and Williams percent range. TTM squeeze. TTM squeeze is also a good one.
So that's yeah, you kind of highlighted quite a bit of indicators. That's volume profile, the VWAP, TTM squeeze, the Williams percent range. Am I missing anything?
Volume profile and Bollinger Bands.
Yeah, and the Bollinger Bands as well. Yeah, there's Moths did drop kind of how to use these indicators in the Discord already. So if you scroll through the channels list and you scroll all the way down, you'll get to the education tab. All you got to do is click on the stocks with the books emoji channel. And there you go. You get a deeper dive on how to use the indicators that Moss uses.
Yep.
But if you go to that channel, the stocks channel in the education tab, and you scroll all the way to the top, I've shared uh, 3 sets of slides as well. There's maybe like 10 to 15 slides in each section. Again, the way to access that is go to the stocks channel in the education tab, scroll all the way to the top, and you'll see TA Part 1, TA Part 2, and TA Part 3. Those are all the basics that you need to know. And it's super beginner friendly. Each slide is just it's just bullet notes on certain topics. So you'll get to learn how to use support and resistance. You'll get to learn how to use MACD, RSI, moving averages, and a lot of other cool things as well. So, I mean, I've been telling everybody for at least the past 2 weeks, you got to go over TA Part 1, Part 2, Part 3. Watch the videos in the playlist I've shared with you guys on learning options, because you've got to be aware of how the instrument that you use kind of moves. You got to know how options work. So TA Part 1, 2, 3. Watch those videos on how options work, and go through the first 2 modules in the dynamic playbook. Hopefully, I mean, I highly doubt that people have gone through all that material, even though by now they should have. So I'll give it another week, but I am going to be opening. Yeah, I'll do 2. I'll be opening 2 more modules, so you'll get access to module number 3 and number 4 for the dynamic playbook. Oh yeah, Gary, the discount code, it only works for the monthly, and it is J-hole. So capital J, capital H, capital O, capital L, capital E. J-hole. It's all one word. When you sign up for the monthly, it should give you a $20 discount. So instead of $45, get in for $25. That's essentially a discount of 2.5 weeks worth of time. Okay, so Demi, you're such a nice guy. He says that if anyone is free tomorrow at some point, he's willing to hop in a quick call in the live trading section in the Discord and give you guys a rundown on how he trades. So I appreciate that. What's the last letter you said? So it's J Hole, Jhole. J for Jackson, H for Harry, O for Oliver, L for living, and E for elephant. J Hole. Let me know if you've got that, just so it's clear. Awesome. Cool. Let me see if there's more questions. Come on, folks. Shoot your questions. Whitey, let's get a question from you too, man. I don't know if you're playing cello or something right now. Jackson Hole. No. I really didn't want to drop it into the chat because I wanted it only for people that showed up today, but it's fine. You dropped it. It's accessible for everybody now, I guess. I'm totally cool with that. Come on, let's try to get at least one more question. Maybe 1 to 2 more, and then we'll close this off. Or if anybody wants to come up and expand this conversation, we could always do that too. I appreciate that seek for wisdom. Let's see. We've got a couple people typing. Hope it's a question. Makes it more fun. Hermit, what's going on?
Just living the dream. How are you?
Same here, dude. I mean, honestly, I'm not gonna lie, I'm kind of exhausted.
Dude, I believe it.
Yeah,
I'll tell you. Sometimes I'd rather be physically tired than mentally tired. And I'll tell you, looking at charts. Not that I look at charts all day like you guys. Um, which for anybody just listening and just getting started, that's what it's going to take to be really good. I'll just say that. Is you got to when they say lock in, you got to lock yourself in, and you got to lock yourself in hard. Um, Question, and this is a dumb question, and some
well,
people
no,
like.
well, no question is truly dumb ever.
I
So
No
I will say,
question is dumb.
yeah,
hey, you haven't even heard the question yet, and I will refute that. I would tell a story on here, but
sure.
I will refute that, considering I used to be a teacher and I tried so hard not to say
Yeah,
that. But anyways, regardless, with inflation going the way it is,
right.
why? And I know they've done this in the past, and I just don't know why they don't do it now. It's obviously it wouldn't be ideal, but to me sometimes drastic measures need to be taken to fix the problem. They're like, oh, we're going to raise the rate 2%. We're going to raise, or not 2%, 0.25%, a quarter of a percent. um, Back in the day, I think it was in the 80s when Reagan first took office, Paul Volcker like jacked up the inflation
Oh yeah,
to something ridiculous. And to me, it's like it should have been done a long ass time ago. Um, but you know, I'm just a internet cartoon. Why wouldn't they just be like, you know what, we're just going to take care of it. We got to rip off this band-aid now, otherwise it's going to get out of control. And I mean, if they did do it, how long would it take? I mean, could it just be like, okay, we're just going to rip the band-aid off, 6 months later they're like, okay, we're good now? Like, what's to stop them from just straight up doing something like that, and why wouldn't they? Also, I've heard that traffic through the Strait of Hormuz has gone up in the past few weeks. What, again, it's from news, and news changes every 2 seconds, where one person says one thing and another person says another thing. But anyways, that's my question,
right,
is the interest rate.
right. So, well, so the job of the Fed members is quite tough. So they face a dilemma. If you hike the rates too soon, you might cause a ripple effect, and it could cause recession. If you hike too late, then you risk inflation being too sticky. Now, from what I've been keeping up with, well, first of all, let me just say that any logical person, they would vote for hiking the rates. Um, but now, from what I've been keeping up with, the Fed members that have dissented and voted for rate hikes, they've been speaking. They've done interviews and whatnot, and they've said that if they're able to hike the rates, then they'll be able to bring inflation down to their 2% target within 18 months. Um, Now, I do believe that 1 to maybe 3 rate hikes could take place. I'm not going to say by the end of this year, but I'm going to say at least by the end of the first quarter of 2027. I I don't think that Well, it's really not looking like that. The price of oil is going to come down, so I doubt inflation kind of drops significantly for the next few months. Um, there's still problems with these tariffs, especially with, recently with U.S. and Canada, uh, and I think they've been honestly, I truly believe that the Fed members have been preparing people for the hike in interest rates. Because anytime Kevin Warsh is speaking, well, like obviously the past two decisions have been to keep the rate neutral or no change. But anytime he speaks, there's always kind of a hawkish tilt to his speech, and he always says that this Fed is going to be committed to bringing inflation down. We know that the best tool they've got to do that is to hike the interest rates. So I believe they've been preparing the markets for this. It's something that's going to get increasingly priced in quite soon, probably within the next 2 to 3 weeks, because that next FOMC is in September. There might not be a rate hike in September because I think the FOMC is before the midterm. So maybe they don't hike the rates in September, but rather in October. But I do believe they should hike the rates. I'm not sure why they haven't just tried to fix the issue already. Jerome Powell, he did a great job in preventing a recession, but he didn't do a good job of keeping inflation down, because his way of kind of avoiding recession was just to print a shit ton of money. They started hiking rates later on in around 2022 to 2023 to try and suck some money out of the economy. Well, some of the money that they printed to try and bring down inflation, but it really didn't have any real effect because they printed too much money at too low of an interest rate. So businesses increase their prices for goods and services. They've kept prices elevated, and in today's world, those prices are still elevated and slowly inching upwards with the price of oil being high as well. Um, but I do believe there should be at least 1 to 3 rate hikes of 0.25%, possibly, and I think they'll do it. They've been kind of preparing people for this scenario. It's all the Fed members almost. Um, they're committed to the 2% target. They want inflation to come down as soon as possible. There were only 3 dissents or 3 votes for a rate hike from the previous Fed decision. But I don't know how it's going to play out next time. If next time there's more Fed members voting for rate hikes, then yeah, we're going to hike the rate. Again, you're absolutely right. They should have already done this. You got it.
I was just wondering that you said that they're committed to 2%, right? And we're talking about the new Fed chair and everything like that. So my question is kind of like I've read like online and the Fed chair has repeated this even before he jumped in office, the new Fed chair. Like he feels like the way that they calculate inflation is wrong and he wants to like change the way they calculate it because he feels like it's incorrect. More or less, I kind of read it like he just wants to read between the lines and artificially lower inflation, even though it's technically not lowered. Like, what are your thoughts on that?
Right. So that's 100% correct. Now, I think when he says that the way of calculating inflation is wrong is mainly because the way that they do calculate it, they're just using surveys. So they're going to different businesses and corporations, and they're making them fill out surveys. Right. It's just a list of questions. Um, and so that's kind of mainly how inflation is calculated. Um, and it's not a great way. Because how do you truly gauge the real change of the prices for goods and services if you're just asking those businesses? I mean, there's going to be great businesses that are truly truthful. There's going to be bad businesses that aren't as truthful. But anyways, those surveys aren't the best kind of form of data for the Fed. So I think they're gonna. I mean, they're just planning on using, I feel like, a more complex way. But you're right in the fact that they're trying to implement a new way of calculating inflation so that they could kind of fabricate the inflation reports and convince people that inflation is low so that they can end up lowering the rates. I do believe that. That's actually something that I posted on the BDT Insights Twitter account. I'm going to look at the exact words I said. I don't remember all the words. All right, here it is. I'm going to post on the Jumbotron for you guys. So there's the post. It was a post of me kind of retweeting it by quoting it. And I quoted a post that Watcher Guru made on that the Federal Reserve is now projected to raise interest rates this year. And I replied to it by saying the Fed may be forced to hike rates in the short term while they build a new framework for measuring inflation. That said, we believe they'll do whatever it takes to enable cuts, own assets. So what I'm trying to get at is inflation is high. The job of the Fed right now is to to maintain their credibility. So they should hike the rates. And what I think is they probably will. But that's in the short term. But as they're building this new framework of calculating inflation, they'll be able to fabricate the reports even more. And I've said this before, all reports are fabricated. Just look at all the inflation and labor market reports that have come out in the past year. They've all come out in line with expectations. No surprise in either direction. You know, people, the general population has said that the labor market has been challenging for them. Well, why don't these reports reflect that? Because they're all fabricated. It's not truly real data. They could adjust numbers in certain categories to make the overall inflation rate seem a certain way. And it's 100% fabricated. You could go back for the past year, look at the reports. They're all in line with expectations. And this is because, well, Trump's gone ahead and he's used his power with his time in office to decrease the government. You know, we had a part of time where the government was shut down. I think this might have been the end of 2025. I know it was the fourth quarter for sure. But we had a part of time where the government was shut down. People thought that, these workers are just going to be furloughed, that they still have a job, they're just not going to be working for a bit, and they'll come back to their jobs eventually when the government reopens. But that wasn't true at all. Trump used this opportunity to fire as many people as he could, decrease the size of the government, and implement the people that he knows will serve him. And so this year, and even for a few months longer than just this year, every single report has come in line with expectations. It's all fabricated. As the new Fed chairman builds a modified framework for calculating inflation, they'll be able to fabricate these reports even more to favor them. So you got to look at the chessboard and kind of try to anticipate what the best move might be if you're in position of the Fed. And what I would say is you hike the rates in the short term, maintain your credibility, and then when you've got that modified framework for calculating inflation, you get you publish those inflation reports. Slowly, people get convinced that inflation is low or starting to come down. Then you've got an excuse to lower the rates. Sure, go for it.
Like I feel like a great analogy for this is like what can you do when the goalpost is like unachievable? It's just too far. Like reaching this inflation rate is just too far because they don't want to. The job market is already suffering. Like how much more can we afford, right? What do you do? And for it to be substantially in lower inflation, right? And how is the government going to pay off their debt? All this stuff. So when the goalpost is too far, you just kind of move it closer, right? So like, let's say the new inflation rate target is technically 3%, but they're just calculating it differently so the public doesn't react and things like that. Like, what do you think about that?
So you're kind of basically saying that instead of their 2% target that has been the norm, they might end up moving the goalposts a bit wider and say that the new norm for us is going to be a 3% inflation target.
I don't think they're gonna say that, but I think their new calculation or whatever, just like how you said they're gonna fabricate it through their new calculation, but essentially it's gonna be that, right?
Well, uh, I'm not sure if they're not allowed to say their new target. I'll be honest. If they've got a 3% inflation target, if they're deciding to move the goalposts for their kind of dual mandate, then I think they, like under the law, have to kind of say it.
Oh,
But I mean, like, but regardless, the point is, what if the new norm becomes a 3% inflation target? Then what I think how the markets would react is they would obviously see that as a big negative because that just means inflation is way too sticky. The Fed was unable to do their job properly. Markets would sell off, but the only thing that would happen is it would yield a lifetime buying opportunity. That's what I would think. That's honestly all that would happen. Sell off, you get a dip, you get to buy the dip, and that's it. You keep going.
but through this new way of calculating inflation, like let's say they're using a new methodology, right? And in this way, inflation is appearing lower than what it actually is, right? Even more so than what it already is, let's say, because you're saying that they're gonna fabricate it with their new way of calculating it. Like, aren't they still kind of moving the goalposts closer?
Sorry, could you repeat that question?
Like, okay, they're not explicitly saying that there's a 3%, let's say. Let's say they don't. But
Right.
like just the fact that they're recalculating their inflation, the way they calculate inflation, so it appears lower than what they're already reporting, isn't that still technically moving the goalpost closer?
Um, well, okay, so let me try to kind of understand what you're saying. I'm a little bit confused. So you're sa- er, and correct me if I'm wrong. So we're saying that what if the 3% target becomes the new norm, but at the same time they're fabricating the reports to to show lower inflation, and and what would that yield for the markets? Is that kind of where you're
Sorry,
getting at?
sorry if I'm confusing. Basically, what I'm trying to say is that, like, so ignore the whole 3% rule because let's say they don't want to go out and say that publicly, right?
Sure.
But just the fact that they're using a new way to calculate inflation, which is going to
Mhm.
show up as lower than what inflation is already being reported by them, let's say, right?
Okay.
Aren't they already moving the goalpost closer by just doing that?
Oh yeah, 100%. I mean, the whole system is kind of fake. It's all built on the faith that people have in the system. If you get to fool people, by showing these low inflation reports, regardless of your kind of inflation target, then you get an excuse to lower the interest rates. And yeah, that is ultimately bullish. I still might not have answered correctly.
No, that was essentially my question. You answered it. It was kind of like it was pretty easy to answer. It was just more of a discussion point, right?
Right, yeah. I think the point of, you know, having the 3% as a new norm was kind of what confused me. But I understood after you kind of clarified.
Yeah.
But yeah, you
Like
fabricate
under
the
the hood,
reports.
3%, like whatever, but it's a higher inflation rate is going to be the new norm if they're changing the way they calculate it to fabricate it, right? So
I mean, 3% doesn't have to be the new norm, but it could be. It's truly all dependent on, well, for right now, it's going to be energy prices, oil, but at some point, it's also going to be the prices for, well, for chips and memory that these tech companies have to face. So I mean, it's like this like news is always shifting. All we can do is kind of just keep up with it. But no, you're definitely right. If they get to fabricate the results of inflation reports, convince people that inflation is coming down, you have an excuse to lower the rates. You pay less on your debt. The markets go up.
and it's all fake because if you look at like the true inflation rate, even that's so much higher than what inflation is currently like right reported by the Fed, right?
Yeah, and I'm not sure, but the true inflation number might be like over 7% or something.
Yeah, it is.
Yeah. I mean, again, the government's job is kind of just to have the general population keep faith in them. That's all the whole system runs on. It gets a lot deeper when you dive into like how it truly works, like the flow of money and how the military works and why they implement certain policies. But it's all a faith-based system. Um, you might have more questions or want to expand this discussion, but before we do that, there were a few questions that came in. Seek for Wisdom is asking, when trading options, how do you pick your strike and expiration? The way that I pick my strike and expiration is for this, well, let's begin with the strike price. I want to get the contracts that are either in the money or as close to being in the money as possible. So that would be, let's say you're buying calls on ticker symbol SPY, and the current price of SPY is 750 per share. For the calls, anything up to 750 and under is considered in the money. And all being in the money is that those contracts hold more value as time goes on. So that's what we call the moneyness of the contract. The moneyness is just how much value it's going to hold as time goes on. I try to stay as close to being in the money as possible because, I mean, we're not going to. One second. My bad. I like to be as close to in the money as possible because I want my trades to hold more value as time goes on. Because it's not always going to be a trade that you're able to get out in, let's say, a few minutes. Sometimes it could take a few hours or a few days to play out. Now, the time factor, how do I choose my expiration? The expiration is all kind of based on how how you're trading, right? if you're looking to get the move that you anticipate off a stock, let's say by next week, then it's quite obvious you take the next week expiration. If you're looking to get or to capture the intraday move, let's say you're day trading, then you can choose either the one or yeah, you can go with either 0 to 3 days till expiration. Um, I would only stick to 0 to 1 day expiration if you're day trading. Um, yeah, I like to be close to the money as possible, and then dependent on how long I plan to hold my trade is how I'll end up picking my expiration. But again, the most important factor is always going to be your strike price. Um, yeah, Gary, that discount code is for 1 month. But again, we always drop discount codes well, the trend has been that we've been dropping codes like every fucking week. But it's mainly targeting the people that show up and put in effort to to become great. Now, there's another question here. How often do you use patterns and charts? I'll be honest. And again, I'm not taking a jab at anybody when I say this, but it's just not my style of trading. So I almost never look at patterns on charts. Because a good analogy for that is looking at patterns is kind of like how humans back in the day used to look up in the sky and look at the stars and make constellations. Like, oh shit, I'm looking at the sky. This star is in this spot. This star is in another spot. It kind of looks like a teacup or it looks like a foot. So I'm going to give that star pattern some meaning, right? Like many tribes, many cultures of people used to do this. Just look at constellations and give them meaning. That's often what humans tend to do. It's just human nature. It's nothing we can change. I mean, humans will always continue to do this. We give meaning to things that don't have to necessarily have meaning. And I relate that to chart patterns. Because why does it have to be that just because you see a triangle on a chart or a square or a circle, whatever it is, that the trade has to go that way? So you can use chart patterns, but don't give that pattern, complete weight in why you're making that trade. You got to combine it, just like Demi said, you got to combine it with other pieces of information. But yeah, I have nothing against people that do use chart patterns, but if you're going to use them, please just try to, you know, connect that with other information, and that's what will help you kind of make a better strategy. Um, all right, so this person asks, what's the impact of bond markets in other countries? And he also, or he or she, I'm not sure, but they also shared a tweet saying the Bank of Korea sold 91-day monetary stabilization bonds at an auction yield of 2.965% as part of its ongoing open market operations. So I'll tell you this, there's many different types of bonds. A company could have bonds. There's government bonds, municipal bonds, and I'll give you examples of how bonds kind of work. So there's an auction for these bonds. They go to investors, and investors get to choose if they want to buy the bond. So let's stick with the example. Let's say your country is trying to build hospitals. You're going to need a lot of money to build a hospital. So you go to investors, you tell them, here's the yield that we're willing to offer you to purchase this specific bond. You give us that money, we'll give you a certain yield on it, which is the interest rate that they're going to pay you. And it's an IOU. It's just a form of debt. They're taking your money to build that hospital, and how you get paid is whatever profit or revenue that the hospital generates is what they'll then use to pay the investors. So that's how bonds work. Another example is, let's say your country wants to build a bridge. They do the same thing. They go to the bond market with a very specific type of bond. They have an auction. Any investor that invests in it, they offer you a yield. They take your money to build that bridge. And specifically for bridges, the toll fee that the bridge generates is what they'll then use to pay the investors who invested in that specific bond. So that's kind of how bonds work. Now, every country out there has its own bond market. It's how you build schools, hospitals, bridges, how you get to kind of help out your Space Force, how you get to do anything in your country, any sort of development. It's mostly through the bond market. Now, what's the impact of bond markets in other countries? Well, countries don't only buy their own bonds. Countries also buy the bonds of other nations. It's to kind of diversify your risk, and it gives you the chance to generate more money for your own nation. So for a long time, many countries like China, they invested their money into US bonds. So what did that do? That helped China generate some money. And at the same time, it gave the US more money to build great things in their country. And so the point I'm trying to get at is the bond market, well, the bond markets are all kind of interconnected. All money in the world is interconnected. Now, we saw more kind of recently, the Japanese yen was facing issues. They needed to raise money. So America stepped in because they realized that, well, if Japan wants to raise money, they're most likely going to sell American bonds. And they don't want that to happen because remember, the liquidity in American bonds has been thinning. The auctions haven't been going too great. That's why we kind of essentially have the US bond intervention. But anyways, so America's seeing that Japan could potentially sell US bonds to help elevate their own currency. America didn't want this to happen. So what did America do? They stepped in and they sold the euro to replace the selling of US bonds to help keep the yen at stable prices. So certain bond markets have direct correlation with other bond markets. If American bonds are going up, there's a high chance that European bonds will be going up too. All money in the world is interconnected. Because again, they don't just buy their own bonds, they buy the bonds of other nations as well. Cryptid Cabal asks, if you had $1,000 to day trade with, let me kind of rephrase that. If you only had $1,000 to trade with, how would you go about it? Well, with $1,000, again, the most important thing will be risk management, because you only get a few trades, and if you're blowing, let's say 50 to 100% of each trade, you're losing 50 to 100% in each trade, then you're going to lose that $1,000 super quick. So the most important thing with $1,000 is going to be your risk management. Cut your losers quick, hold your winners as long as possible, and don't size big into a trade. Start off with buying only one contract. Try to kind of increase your capital over time. Let's say it could take I want to say a few weeks, and then let's say you're able to get to maybe between $2,000 to $5,000 in your account. At that point is when you can think of sizing up for your trades. But don't size up on a trade just because you hit one trade. You've got to hit a few trades consistently to be able to size up. So it's all going to be position sizing and risk management. It's definitely doable to work up $1,000 to whatever, but that's how I would take it. Few trades. You don't have to be trading every day, but the trades that you do make, you got to be super confident in. Hold for as long as possible. Whoa. Aim for 10%, keep stop loss at 90%. No. Yeah, don't keep your stop loss at 90%. He might have put the wrong symbol. He put a negative 90%. He might have meant to put in plus 90%. I'm not sure, but don't keep negative 90%. You want to get out of your losing trade as soon as possible. Because if you're sitting down like over 50% in a trade, the only thing you're relying on is hope. You got to be super lucky for that trade to go back to break even, and then to go back to profit. You got to be even luckier. So, yeah, negative 90% isn't good. Let's see. Oh yeah, my bad. So that person was joking with negative 90%. He says, okay, no trouble with $1,000 port. I think the RR of day trading is very small. Just buy yourself time and save yourself the stress. You're likely gonna overtrade with 1,000 and be tempted to size way bigger. Yeah, exactly. Don't size up too much. Stick with one contract. Okay. Day trade should be 1 to 2% of your port. And most people hate that because everybody starts off in different places. But here's my thing: you will blow up your account so quick. Being overly leveraged in a day trade creates a thesis. Watch your levels and indicators. Enter with time and let it play out. Plenty of time for you to hit green at some point. Well, I mean, he kind of highlighted exactly what we've been saying. Do your due diligence, watch your risk management, and that's going to help you be more confident in your trades. Those two things alone they're going to go a long way. Yeah. Oh, my bad, Gary. Uh, there you go. You've got full access. Uh, let's see if we don't get another question or someone expanding this discussion today within the next minute, then we'll start to wind down. But it's all up to you guys. Got questions? Keep shooting. You want to expand the discussion? Go for it. But let's give it 60 seconds. And while we wait, I'm just going to take a look at Polymarket for what gamblers are pricing in for
Hey, that's
the
not
interest rate.
gambling. That's educated guessing.
Well, for some people, yeah, but I mean, we got to be honest. A lot of people are just gambling. That's that's at least what I think. Uh, sorry, let's take a look at it. Okay, so there is, and this is for the September meeting, is 68% of no change, 32% of a 0.25% hike in the rates, and 1% of a rate cut. So it's looking like no change at this point. Uh, and the midterms probably have a lot to do with it. I mean, the Fed says they're independent, but I think there's always going to be people on the Fed board that are politically motivated because they've got a job to keep. You know, it's easier to keep your job if you please certain politicians.
Wouldn't they be pleasing the Democrats if they, I mean, if they did a hike, then
Yeah, that would be great for the Dems. Um, I mean, there's a few Fed board members that President Obama and Biden implemented, and those board members have stuck around, and they've really been the ones that have been dissenting and asking for rate hikes. So there's a few people that are definitely politically motivated.
so I don't know if you covered this or not, but like, how do markets open tomorrow?
How do they open? So what I tend to look at, so I do my due diligence every day when I wake up, but I also do it on the weekends, not on Saturday, because I mean, there's no real kind of reaction in the markets on Saturday. All you're looking at is pure price action for crypto. But Sunday at 3 p.m. Pacific time is when the futures market opens. And at that point, we kind of get a look on how stocks are trading. So look at the upcoming week using the economic calendar, get kind of ready for any catalysts that could affect the markets. And then at 3 p.m., I'll look at the futures market. So that would be the NASDAQ futures and the S&P futures. Right now, the S&P is up 0.01%. I wouldn't even consider that noticeable. That's just flat. But the NASDAQ is down 0.1, let's just round it up a bit, 0.2%. So tech is down a bit, but the broader market hasn't seen any significant move. The bond market yields are also open, so the bonds have moved down a bit from their rise at the end of last week. Okay, so the way I would price this in, if well, the first thing we got to see tomorrow morning is we got to see what sectors are driving the markets. Um, if the industrials are kind of staying stable to picking up, and the technology sector isn't down too much, then I would honestly try to play long. Because if the bonds are down, then stocks should be up. That's just the way I look at the markets. They have an inverse correlation. So if you see bonds and oil down, you go long on stocks and crypto. And for crypto, we're actually in a beam and R trade. That's tied directly to the price of Ethereum. I've highlighted that 2450 on ETH is currently the overhead supply zone. There was a decent move down on Saturday. It moved down to 2350, but it's then gone up, still sitting at 2450. Still in the supply zone, is consolidating here, which is super healthy. I would honestly be going long on ETH, and if I'm going long on ETH, then I would also be long on Bitcoin.
Bubbles never perish. Tough guy.
Never. I mean, being a doomer, it works for maybe a few weeks to months, but you're only ever gonna make money if you're long on the market. So you got to be optimistic. You got to, as humans, we cause problems, but we also work to fix those problems. So that's something that helps the markets go up over a long period of time. I know crypto is seen quite the move down over the past year, but I'm someone that believes in this industry as a whole. So I would keep buying crypto. I mean, but I'm kind of satisfied with the amount that I have invested, and I like a little bit of diversity for my investments. So I wish I could force myself to buy more. I probably won't, but if you're somebody that is looking for a place to put your money, crypto is a great place still. Super cheap. Gold is running up though. Gold is up 1% so far. It's now trading at 46.50 an ounce. And I do believe that gold is headed to trade in the 5-figure category. It's trading at 4 figures today. It's going to start trading at 5 figures quite soon. So that would be over 10,000 an ounce for gold. And that move in gold is going to be driven mainly by China. China's built the world's biggest gold vault. They want the global gold trade to be settled in China. It helps them support their currency. And they've done all the right things to make that happen. They've stashed up on gold, built a huge vault. They've built a huge exchange. So gold is going to go places. But yeah, bonds are down. I'd be looking to go long on the markets tomorrow, at least at this point. And then that Scott Bessent press conference is also tomorrow, so we might see a reaction in the bond market when he speaks. Oh yeah, to add to that bond intervention, they announced a 4 billion per month operation, but that same week he also did say that if they need to, and I think they do plan to, that they could bump up their repurchases of bonds. So instead of 4 billion, could be a bit more, could be 5 billion, 6 billion, who knows. But yeah, their goal is just to drive down long-term rates, keep inflation reports hopefully stable or low, gives them an excuse to lower these short-term rates. At that point, it becomes a lot easier to pay off the national debt. And there you go. You've saved your country from collapse. which is
To me, I'm no expert, but it seems like buying bonds is just another way of printing money, and printing money drives inflation.
yep, that's that's exactly what it is. I mean, and that's
So, I mean, that's
yeah.
good for crypto, right? Because we all know what happened when they printed money, but it doesn't solve the problem of the debt.
Oh yeah, the debt-based system is kind of weird. Uh, all they're doing is just kicking the can further down the road. Uh, I mean, it just makes sense to own assets, right? Like whether it's real estate, stocks, crypto, just got to own assets. It's the only way that you'll be able to beat the inflation rate and the printing of money.
Well, that's what a signal of that is when gold goes up and Bitcoin goes up. Usually, like that, people are getting into those because of they think the American dollar is going down.
Yep. Currency, yeah, currency debasement is is kind of what we're getting at. But it's quite a complex system. Like, I mean, I've been trying to study it for years now, and I still don't truly understand it. But I mean, with the little that I do understand, it kind of helps judge future outlook. Um, okay, so now we've been running this space for 2 hours and 30 minutes. At this point, I'll say the same thing again. If there's no questions or anybody wanting to expand this discussion, then we could go ahead and end it off. We'll give it 30 seconds.
If you want to learn about the Fed, read the book The Creature from Jekyll Island. That's it.
I like that. The creature from Jackal Island. That's what you said, right?
I'll type it in the Discord.
Amazing. Yeah, that's a great book, and there's also another great book that I've shared in the book section. I always try to get people to read it. It's called The General Theory of Employment, Interest, and Money. All the 3 points that drive markets: inflation, the labor market, and interest rates. If you want to dive deep into it, you read that book, The General Theory of Employment, Interest, and Money, and also the book that Hermit just shared with us, The Creature from Jekyll Island. Okay, so nobody's expanding the discussion further. I think we've had a decent discussion. We mentioned oil, which is connected to inflation. That's all dependent on U.S. and Iran relations at this point. And the next step that the U.S. has taken to make Iran bend the knee is they've announced economic warfare. It's going to be higher tariffs, and what was that word? Higher sanctions on countries to make sure that they don't trade with Iran, and Iran is hopefully forced to make a trade deal. We've talked bonds today, the U.S. intervention in bonds and how that could affect the markets. We've also kind of mentioned the Fed, um, what the Fed could potentially do, and how certain things may impact Fed decisions. We kind of went over the path to profitability, what every trader should try and implement into their trading to ensure success over a long period of time, and we had a great Q&A. But at this point, it's been 2 hours, 34 minutes, no more questions, and we can end off tonight's space. I appreciate everybody that showed up, everybody that asked questions, added to the discussion. I hope everybody had okay, EAC, go for it.
I just wanted to get in my closing statements too.
You got it.
I wanted to, say thank you, Bubbles, for putting on these spaces. If anyone listening here ever wants to hear it again, you can go to EAC NFT, so Rumble /EAC NFT, and I got this space recorded, and I'm going to be recording the upcoming spaces every Sunday. And I also have a space called Designated Degens that Hermits puts on for just what's happening in the markets on the crypto side. So if you ever want to go back and listen to those, you can. So Rumble, that's EAC NFT. It's finally cool that Hermit doxed himself with his PFP. So I'm glad to see that. And just thank everyone for showing up, and see you next week.
Hell yeah. EAC, you could also share that link in the Discord if you want. You could share that link. You could tag everybody just so that they know.
For sure, we'll do.
Yeah. Anyways, Hermit, EAC, Ayush, everybody else that showed up. I hope you guys had a great weekend. At this point, the weekend is pretty much over.